is Sakavich, Director of Marketing at Quantifi, a provider of risk, analytics and trading solutions for the global financial markets. I'll be moderating today's webinar on the trends and dynamics shaping portfolio and risk management capabilities. We are delighted to have Celent, a leading research and advisory firm, join us today. The speakers for the webinar are Abdu Naik, Head of Solutions at Quantifi, and Kubla Stingh, Research Director at Celent. During the webinar, we will be conducting 2 polls, and at the end there will be a short survey. Your input to the polls and surveys will be much appreciated. Once the presentation is complete, we will open up to a Q&A session. You can use the pane on the right of your screen to submit questions. We will now move on to the presentation. As active managers search for returns on value-added alpha within a dynamic market besieged by low but rising interest rates, buy-side firms are also facing pressure from increased regulatory compliance and transparency requirements, structural market changes, the influx of digital technologies, as well as continual shifts in investor buying behavior, product preferences, and performance cost perceptions. This webinar will provide insight into some of the challenges and trends shaping portfolio and investment risk management. I will now hand over to Kubla Stingh.
Thanks, Attribution. Now, let me start by saying that the post-global financial crisis environment has been largely favorable from the standpoint of the investment sector in terms of things like asset gathering, AUM growth, and also revenues for the industry as a whole. And this has been fueled by things like quantitative easing and also the general appreciation of asset prices globally. But until last year, these favorable conditions have largely, in our opinion, masked out certain fundamental aspects of the industry's growth, especially around the contraction of margins, as well as the business case to address a number of structural challenges and trends that are reshaping the industry, which I'll talk about here briefly. Now, the first trend is, of course, the ongoing shift from active to passive investing. And here we expect this shift to continue its momentum, for example, moving from equities to fixed income ETFs, which we believe will be significant in the next few years. And therefore, this will put pressure on margins as well as the broader economics across the investment industry. Now, active management will still represent an opportunity for many firms, but only for those that can demonstrate value for money and also the sustained ability to generate alpha as a whole. Now, secondly, we see changing economics and also the nature of investor demands. These are all creating competition based on an ongoing expansion into alternative assets. So you have hedge funds, private equity, and real estate being the most common, but also other emerging alternatives that are coming on the horizon. Now, thirdly, in line with this expansion of assets, we see institutional investors becoming more bespoke and also outcome-focused in their requirements. And this is underpinned by new investment strategies and portfolio construction techniques. So, for example, through hybrid fundamental and quantitative portfolio construction, you have smart beta, you have alternative premier type techniques, and also ESG investing that is becoming more prevalent in recent years. Now, at the same time, in an environment of sustained margin pressures, we already see imperatives by asset managers to achieve a leaner cost base through automation, through systems rationalization, and also outsourcing. And as part of these activities, firms also are modernizing and re-engineering processes as part of their technology upgrade cycle. And then the final point here is around new technologies and fintech service providers who are increasingly directing their efforts to use cases within an investment management context. And some of these use cases are potentially disruptive, whilst others can be complementary to existing buy-side ecosystems, such as through custodians, administrators, as well as common front-to-back systems. Now, I'll expand each of these points in more detail and share what it means, especially from an investment management technology and operations standpoint. But just to note that some of the data points that we are presenting here would actually strongly suggest that these trends are not merely cyclical, but structural in nature, and therefore would require a concerted response from both asset managers and asset owners alike. Now, I started talking about the industry's changing economics and the ongoing downward pressures on asset manager margins due to price competition, for example, from the onslaught of passive vehicles, also investor pressures and ongoing regulatory scrutiny, despite the fact that the industry has experienced largely positive AUM growth over the last decade, as you can see on the left side in the blue line. Now, in 2018, as shown on the chart on the left, you see that AUM growth fell for the first time in many years. Now, historically, cost structures are stubborn to change, and we show this on the orange line here, and you can see that aggregated costs across the investment industry has been increasing over the past decade. And at this point in time, the combination of persistent margin pressures, uncertain business conditions, and also slowing revenues are leading many investment firms to rethink or reshape how they go to market operationally. And some of these changes are no longer nice to have for certain firms anymore. Now, on the right, you see a recent survey data which points to where investment managers are rationalizing costs and directing investments. And you can see in the red bar that, that even core areas such as portfolio management, dealing, and trade execution are under the spotlight to undergo cost reductions and streamlining. So basically, you see here that firms are looking to address operational inefficiencies and costs associated with siloed and fragmented systems. Now, on the other hand, as indicated by some of the green bars, you see that new technology is also viewed as critical to a firm's competitive advantage in order to drive better investment decisions as well as regulatory operations. And this can be observed in the data here, where there is increased investment in new technology areas such as big data, machine learning, and also the ongoing thrust to digitize operations in areas such as compliance in order to make things more efficient. But the key takeout here is that you see asset managers are attempting to both defend and enhance their core investment engine. And we see a growing number of firms changing their operational and technology models to ensure a more defensive position in the light of growing uncertainty in the coming years. Now, more and more since the global financial crisis, the expression multi-asset is becoming a term that implies a broad gamut of alternative assets. So not merely fixed income and equities, but also a relatively established asset classes such as private equity, hedge funds, and real estate. And this continues to actually broaden into other so-called emerging alternatives, so such as infrastructure, private debt, as well as insurance and bank-related assets. Now, in chatting to Quantifi and in sessions prior to this, they mentioned that they have an established heritage in some parts of the alternatives chain, namely fixed income and credit. So I'd like to bring Everhood into this conversation to actually share what they are actually seeing on this front, which perhaps has a more nuanced view based on where they are starting from. Everhood, do you want to share some thoughts here?
Sure. Thanks, Kublis. Good morning, good afternoon, everybody. I can provide some color on what we are seeing on the ground from our perspective as a PMS technology provider to the buy side. In general, the trend we have seen over the past few years is consistent with the analysis Kublis has presented. Buy-side firms across the spectrum, irrespective of risk appetite, right from asset managers, insurance, pensions, sovereign funds to hedge funds, are broadening the domain of their investable asset classes. Some of the broadening is in established asset classes, but there is also interest in new structures or in market segments that traditionally buy-side firms have not played in. Some examples of expansion into established asset classes are increased allocation of assets to asset-backed securities, so like CLOs, agency, non-agency, CMBS, and RMBS. Other variants in this space, there is a lot of activity that we see in CLO warehousing, for example. Another example of expansion into established asset classes is the revival of the dormant structured synthetic credit market. So we are seeing a lot of interest in synthetic CDO structures, so much so that there is ramp up on the sell side as well to cater to increased demand for these products. Now, for some examples of expansion into completely new market segments and new structures, so some examples are direct lending. So this has been there for some time since the credit crisis. A lot of banks have stepped out of this business, and then that void is being filled by buy-side firms. But there are also, we're seeing variations on this. I mean, direct lending, in direct lending, typically banks get rid of a bunch of loans from their balance sheets. But variations on this is not actually transferring the loans out of their balance sheets, but just buying protection for credit risk. So an example, we're seeing a lot of credit risk transfer structures. An example is like regulatory capital trades, whereby a buy-side firm writes protection to banks on credit risk associated with the bank loan books. And also, as Kublis mentioned, we have come across hedge funds that are writing reinsurance cover to insurance firms. So these are just a few examples of the new asset classes being explored by buy-side firms. I'd like to comment a little bit on the drivers. So we believe some of the drivers for this trend are one, sell-side firms are moving away from traditional businesses because of the amount of regulatory capital they need to hold to support these businesses, thus opening up opportunities for others to step in. So that's one. Number two, opportunities for essentially regulatory arbitrage. So banks wanting to get risk off their balance sheets. Number three is search for increased yield on the buy side. And then lastly, we see more sophistication on the buy side. There is like increased skills and expertise to manage complex asset classes on the buy side. So we think these are some of the factors that are contributing to this trend. Over to you, Kublis.
Thanks, Everhard. I think this is very helpful in just providing a bit more color on this. Just to say that, one of the reasons we've included this data is that, as Everhard alluded to, we see long-term investors such as pension entities and also sovereign wealth funds. They're all venturing further into more esoteric alternative asset classes. If that's the case, there's alternative classes and there are more esoteric ones. And our opinion is that these satellite alternative portfolios must not, if possible, be allowed to degenerate into independent asset class silo from a technology and data standpoint. So if that's one thing that the investment sector can take from the banking industry, is that they should find ways to embrace operational strategies that actually converge rather than allow systems to remain siloed and fragmented across the firm. Now, in the same context, we also see investors asking more from their asset managers, because we see that whilst off-the-shelf type fund products and performance are important, we see investors are seeking for more tailored, outcome-focused investment solutions beyond the traditional relative benchmark investing. And they're coming up with requirements to achieve a total return, or to enable more sophisticated hedges, or to meet dynamic risk and return type profiles. And these would usually involve more complex derivative strategies as a whole. Now, in more straightforward cases, you see portfolios are tied to bespoke benchmarks, whereas more complex requirements may involve triangulating parameters such as inflation, active risk, longevity, as well as sort of volatility type targets, for example, in liability-driven mandates. Now, in some of these mandates, given that it would involve some element of absolute return or employing more complex derivative strategies, I would again ask Everhood to lean in to give Quantifi's point of view, given the firm's heritage in this particular area around derivatives, credit, and fixed income, which provides a bit of color for what you see in the market.
Yeah, I mean, I agree with your observation on the trend towards tailored outcome-focused investment solutions. And what we are seeing is that these custom investment solutions require bespoke business processes and technology solutions. So based on our experience, we are seeing some related trends, such as there is not much appetite to build custom solutions in-house on account of the complexity involved and the cost of employing and retaining a large technology team. This has resulted in increased demand for external technology solutions. On the retail as well as institutional side, we are seeing demand for custom solutions that cover a broad range of asset classes, and this is related to the point we discussed earlier. Also, the level of sophistication demanded in terms of analytics and risk management is much higher on account of the broad asset class coverage, as well as the higher level of expertise of buy-side firms, which we have seen increase over the past few years. Over to you, Curious.
Great, thank you, Everhood. For me, I know this is a busy slide, but the key takeout here is that when serving clients in this particular manner, in terms of providing customization and more complex solution, this would actually require asset and wealth managers to actually have access to advanced tools and data environments that can both combine quantitative as well as qualitative research. So basically environments that can handle forward-looking strategy modeling and backtesting via a true cross-asset or factor lens, and also to enable portfolio teams to collaborate, share, and analyze strategy ideas in order to quickly design and assemble tailored portfolios for client mandates. Now, in many ways, we believe that the industry is also at an inflection point. Now, on one hand, you see margin pressures are forcing firms to remove costs and to streamline core technology and operations. And this comes at a point where technology suppliers themselves are also expanding their functional footprint across different parts of the asset management value chain, as we show here. Now, these combined dynamics are opening up opportunities for investment firms to rationalize, consolidate, and pivot their applications landscape towards a more fit-for-purpose configuration. So in terms of reducing costs, increasing automation, as well as process efficiencies. Now, we are observing a few specific areas which within the asset management ecosystem where convergence is actually taking place. The first one is the area of trade and order management, so OMS and EMS is one area that is already well underway, where we have seen firms collapse as many as more than 6 applications to just one or two. And this depends, of course, on the complexity of assets and investment strategies that are employed. Now, in the coming years, we anticipate more to come in terms of convergence, especially in areas where there are what we would term as parallel asset class-centric applications, such as for portfolio management and construction, for instance, across equities and fixed income, as well as to better align across applications for derivatives and alternatives. Now, risk measurement and performance attribution are also areas where firms are evaluating the potential to converge, and both these areas have data sets as well as analytical production activities that overlap significantly and hence have the potential to actually consolidate across the different areas. Now, the key takeout here is that in the medium term, in tandem with outsourcing and greater automation, we expect that investment managers can achieve cost reductions of up to 25% if they adopt an ecosystem approach to streamlining their technology and operations landscape. Now, I'm going to pause here to see if Everhood has additional thoughts on this particular slide, but also I would encourage all of you to submit questions if you have any. Everhood, do you want to add to what I've just said?
Yeah, we have observed a clear trend towards optimizing solution architecture, more so in the hedge fund space, where firms are embracing cloud strategies to address the modern business imperatives of performance, flexibility, and agility. Time to market in a fraction of the time previously possible is also a factor, as is the ability to scale faster and more efficiently. Over the last couple of years, we see a number of established as well as startup funds looking for a lightweight end-to-end solution that can support front office risk as well as operational requirements and can also scale as the firm grows and the AUM grows.
Great, thank you. Now, so this slide basically talks to some of the convergence efforts that are happening within the industry. But our view is that these efforts do not actually necessarily extend or enhance capabilities for investment firms to drive more consistent alpha. And that's what I will be covering in terms of technology enablement and also some of the next generation capabilities in the coming slide. Now, before I do that, I think we have our first polling question, and I'll just pass it on to Satya and the team to do this, and then I'll come back on the next slide. So,
great, thanks, Kublis. Yes, so the question for the first poll, which parts of the investment technology value chain do you see converging? So the poll will open, and it will remain open for the next 30 seconds. So I'd encourage you all to take part, please. So we've got the results coming through. So the top two are the most popular responses. So portfolio construction optimization on 38% and portfolio risk models / analytics on 71%. So again, back to the speakers to get their thoughts on the results.
Yeah, I can start first. So portfolio risk models and analytics, I think that's quite remarkably similar to recent surveys that we did actually in terms of, and you'll see that later on as well with some of what we're presenting in terms of just firms wanting consistent multi-asset class analytics and not just analytics in different asset classes, and there isn't a consistent framework that cuts across different areas. Portfolio construction and optimization, I think that's that's probably right. We see firms have sort of different tools for portfolio construction optimization, and the tools are usually tied also to specific asset classes. So I think if you want to optimize across different types of assets, maybe you do need a tool that's converged across different types of instruments. So I think that's good. So, Edward, anything else to add?
Yeah, no, I also think this is consistent with the trend we are seeing. I think it's by far the highest in the risk modeling and analytics. So consistency of numbers is a big factor. Portfolio construction and optimization as well. I think we'll talk about this a little bit on the next slide, because there is just, I think, the new technologies on the horizon, like BI and big data and artificial intelligence, I think lends itself particularly well to this problem. So maybe there is some influence of that as well.
Great, thank you. Okay, we can continue with the next slide. So we talk about emerging technologies here, and so you know, over the last few years, with emerging digital technologies rapidly advancing, we expect this to have important implications for the asset management value chain, as we show here. Now, at present, investment activities around things like fundamental research, security selection, portfolio modeling, and trading are being challenged by digital adopters. So where some of the more visible examples have been in the so-called sort of robo-advisory type offerings for wealth and retirement planning. And just from, if I were to recall, just from some stats that I've seen, you know, in Europe alone, there are close to 100 of these robo-providers in the region. And so you can imagine the level of competition with traditional asset management firms or traditional financial advisors. But here, these firms are evolving their propositions towards more tailored advice and also automated implementation of portfolios using ETFs at lower price points. So with the aim, of course, to deliver a better user experience and also better investment outcomes using smart algorithms. Now, across the value chain, we see pockets of innovation, which in and of itself may not necessarily be groundbreaking, but we believe that there are interesting signposts to some of the substantial changes that are coming. And I'll highlight here a few examples amongst the many that we see. Now, for sales, distribution, and advice, we see that investment offerings are likely to become more targeted and reflective of an investor's financial goals and risk appetite. So you can use advanced data mining or machine learning techniques to actually understand an investor's financial goals and risk appetite, for instance, based on sales, risk, performance, and fund consumption data. Now, for research and ideation, both retail and institutional investors now actually have access to resources that can enable them to gauge and evaluate market sentiment. Now, they also have access to more specific market intelligence based on alternative data sources. So from areas such as social media, you know, geospatial data sets, as well as to be able to even crowdsource investment strategies that we have seen firms come up with. And then finally, we are seeing firms researching and applying machine learning algorithms, so around more accurate classification, regression, and unclustering of data. And these are being applied to specific investment activities such as security selection, portfolio construction, and also risk budgeting. Now, just to say that whilst AI techniques are not necessarily new, the phenomenon here is that there is growing availability and access to computational resources, which are driving more experimentation and also innovation across different industries. And I'm sure that Everett and the Quantifi team see that as well. And do you want to provide some thoughts on what you guys see in the market around innovation and some of the things that I've mentioned here?
Sure. So we are seeing some forward-thinking firms reevaluating their business processes for opportunities to leverage emerging technology. So in our experience, I think, which is consistent with what you said, the new technologies lend themselves specifically to particular problems. So it's not evenly spread across the value chain, but in niche functional areas. So for example, portfolio construction and optimization, where techniques using technologies like AI, machine learning, and big data are being explored by a number of retail as well as institutional asset managers. Also, just as you pointed out, the sheer access to resources and a higher level of computing power is changing the way things are done. So we are seeing more and more firms are demanding real-time and on-demand P&L and risk, even for OTC asset classes. Okay, earlier in the past, we have had this demands mostly for securities, which like tick during the day in the market, but there is demand just because the resources are available, and to crunch a lot of numbers, there are firms which are demanding a higher frequency of P&L and risk for OTC asset classes. Also, there is demand for more computationally intensive analysis on a similar note, but like simulation-based multi-period stress and rebalance cycles to do better liquidity risk management. So it's just like we have had large asset managers who are asking for forward-looking stress testing, but not just limited to stress testing, but the stress and rebalancing response across multiple cycles, which is something that it's now possible because of the computational power that is available.
Great, thank you. Okay, before I move on to the next slide, I just have to say that this particular slide that we have is sort of an optimistic view of the future in terms of digital adoption. Now, if I were to play a devil's advocate as an analyst, I would say that a digital-first strategy that can support the scaling up of some of the capabilities that I've just mentioned can only be enabled and activated only when data and architectural foundations are actually sound. Yet, in more cases than not, firms are not necessarily there yet, as we'll see in the next slide. Now, this particular slide is sort of a contrast to the previous one, and it's perhaps more pessimistic, mainly because based on our own survey data, and this was done last year, we are still seeing some of the issues that are quite rudimentary in terms of pain points that are related to conventional data and analytics enablement across different firms. Now, we see that portfolio managers are facing barriers to access consistent portfolio and risk analytics that are interactive, granular, and multidimensional, and especially based on fresh data, as Everhood also alluded to, and also converged across asset classes with transparency around things like factors in order to drive better investment decision support. And I think this is consistent with the poll that we did earlier in terms of just wanting to converge the analytics aspects of things. Now, risk management functions, on the other hand, share similar priorities to have broad cross-asset portfolio and risk analytics. However, the emphasis here is on achieving a firm-wide view of exposures, risk, and performance, as well as reducing inefficiencies and costs associated with data aggregation across the firm on a larger scale. Now, on both fronts, some of the fundamental challenges faced by portfolio management and risk functions cannot be solved merely by adding more functionality. Now, if I were to remind you on some of the things that we stated a few slides ago, we pointed to the fact that firms need to adopt an ecosystem-based approach to reduce their application footprint and to centralize core investment data sets. Because in the coming years, in order to realize the full potential associated with next generation digital technologies and approaches, sort of ones that we talked about in the previous slide, we believe that firms will need to have more meaningful deliberations around what a fit-for-purpose application and data ecosystem should actually look like for their firm. And this is not merely to achieve a leaner cost base, but also to set down modern technology foundations in order to embrace the new capabilities which I talked about earlier. Now, how else could you implement AI, for instance, if you have out-of-date systems? Now, I'm going to move on to the next slide, and I think we are reaching the second poll. So I'm going to hand it over to Satvir, and then I'll come back to just draw the presentation to a close with my last slide. So.
Thanks, Cubulus. Okay, so the question for the second poll, which next generation technologies would have the most significant impact on portfolio and risk functions in the next 5 years? And again, the poll will remain open for 30 seconds. Thank you. Great. Okay, thank you very much. So just looking at the results, so the top two technologies, we have big data / alternative data, and artificial intelligence and / machine learning. So going back to the speakers to get their perspectives and opinions on this.
Alvaro, do you want to start first? And I'm happy to start first, but you want to?
No, I can go first. I can go first. I think this is pretty much consistent with what we have presented till now. I mean, AI, I think I am not surprised AI and big data are listed as the top two. High performance, as I said, often underestimated, but the sheer amount of resources that are available to today's firms as compared to, say, 5 years back, there's a huge difference. As for blockchain, I think there was a lot of talk about blockchain a couple of years back, but it has been dialed back right now, and I think there is more attention on being focused on AI and big data. Over to you, Cubulus.
Thanks. I'll just offer a few thoughts. I think the top three is sort of in the ballpark of what I see as sort of would get the most impact. I would sort of perhaps when we do our surveys, we see actually big data coming up higher than artificial intelligence, and this is sort of the other way around. I think that there's still, sometimes with AI, there's still a lot of hype in the market, and maybe that's reflected in this. But we see that investment managers, generally in terms of big data, in terms of having access to infrastructures and sort of tools to manage data, that's usually important. But this is reflected here as the second most important one. So I guess it's sort of ballpark in the same area. So thank you. So let me close with I mean, it was a simple slide anyway. So let me close with a few perspectives on pursuing fit-for-purpose solution strategies. I think we talked about it earlier, and these are based on our recent research and experience with helping clients. Now, firstly, when selecting solutions, targeting 80% of functional coverage is often a good rule to follow, but we would advise firms to be cognizant of how quickly the solution can actually be adapted, because certain applications may have less extensive functional coverage, but their systems architecture and data foundations, for example, through things like microservices or native cloud designs, can actually play to your advantage in the longer run in terms of adaptability and also total cost of ownership. Now, the investment vendor ecosystem we've seen over the last few years is also increasingly bifurcating into integrated platforms versus what I would term as federations of best-of-breed providers. And hence, how your firm actually selects, integrates, or partners with the changing vendor market will actually depend on how you envisage a fit-for-purpose operating model to actually look like within your own firms. Now, in our recent research studies, we highlighted 4 main archetypes that we believe are fit for purpose in our reports. And these are usually nuanced by an investment firm's strategies, their asset composition, and also legacy technology starting points. And we would often advise clients to take steps to evolve towards one of these operating blueprints as consistently and practically possible. And then thirdly, in deciding on next generation platforms, what we typically advise clients is, do not let functional use cases and features hog the entire discussion. We will advise firms to actually look under the bonnet to consider elements that would enhance the maintainability, adaptation, and future-proofing of your investment before you make it. And then the last point I had here is that in a convoluted and converging vendor landscape, which is especially pertinent for portfolio and risk management systems at the moment, we ask firms to ensure that you understand a vendor's DNA and solutions heritage, as well as the trajectory of where roadmaps and investments for specific product domains are headed. Just to give an anecdote of what we have encountered recently, we had a conversation with a large insurer with substantial investment portfolios and also capital markets activities who was looking to change solutions only in less than 1.5 years after making their initial purchase. And they're currently waiting to get out of their contract, so for the contract to expire before they actually can actually get a new solution. Now, when we ask them why they're changing systems only in such a short time, their comment was, what we got then has not lived up to what we expected, and certainly not where the vendor seems to be going. And so this anecdote basically highlights to us the last point that I'd like to make, which is that firms need to deliberately focus on items which we would consider as important intangibles when defining or implementing solution strategies. Because in most cases, you can actually select for current functional needs and to some degree future functionalities, but a platform's architectural foundations and other intangible factors are likely to determine how quickly you can adapt, extend, or expand into the future. And this is becoming an important priority for more forward-thinking firms that we have encountered or had discussions with. And so with this last point, let me just see if Everhood has additional comments to make, or else we can just hand the session back to Satchveer to open it up to the floor for any questions, or we can just tackle some of the questions that we already have at the moment. So.
Yeah, thanks, Cubulus. So I will comment from the other angle. So you sort of recommended some strategies for solution providers, for firms that are seeking a solution. So I would comment from a solution provider's perspective, from our perspective. What do we think are how do we need to react to these trends to stay relevant in the market? So one is develop strong business and domain knowledge. So it's not about just technology. I think we need to, for today's bespoke, more custom solutions, we need to demonstrate we understand the business very well. Deliver broad asset class coverage and associated analytics. Number 2, offer compelling PMS infrastructure, but at the same time, the infrastructure is flexible and can be adapted to our customers' business processes. I think this is very important. And finally, be agile in translating emerging technologies into functional solutions. So with that, I will hand it over to Sachveer for the questions. Sachveer.
Great. Thank you, Avdu and Cubeless, for your informative input on this topic. So we'll now move on to the Q&A session, and I can see we've received a number of questions. So just looking at what we've received. So there's one here, which I think Cubeless is probably relevant for yourself. It says you mentioned about the architectural archetypes that investment firms should pursue. Can you explain what they are, please?
Okay, thank you. I will. So we, in our recent reports, we actually covered some of the four archetypes, what we would term as sort of fit-for-purpose archetypes, based on just the various approaches to the investment technology stack, which are in line with what we see in asset management firms, as well as the evolution of where vendors are actually going. Now, it's probably difficult to explain without a reference to a diagram, but I'll try. So what sort of archetype that a firm pursues would actually depend on your starting point, and it can range from having a core front-to-back platform across different asset classes with embedded satellite components, right up to pursuing a best-of-breed asset class-centric front-to-back system that's aligned from a risk management standpoint. So you have asset class, basically front-to-back systems that are specialized in different asset classes, but you integrate it at a risk management layer. And then alternatively, you could also have sort of best-of-breed satellite portfolio construction and optimization applications. And I think it goes back to the point in the first poll that people see portfolio construction being one of the areas where you can actually converge applications, and that's one of the models that we look at. So you converge portfolio construction applications, and you link it to an integrated PMS, OMS, EMS, which also plays the role of a market risk system as a whole. So these are sort of the different types of archetypes, and all four of them are actually viable strategies to actually embrace. So a one sort of front-to-back type system approach is not always the most effective solution strategies, especially if you have significant asset classes beyond just equities and fixed income, and you need some sort of specialized capabilities. So that's all I have.
Great, thanks, Cubeless. So another question here, which I think is, again, probably for yourself, Cubeless, just based on the comments you made earlier about emerging technologies. So the question is, there is a lot in the news about new and emerging technologies, as you mentioned, such as AI, blockchain, impacting the financial sector. How much of this is hype?
Interesting question. I mean, over the last few years, there has been a lot of hype, and there's no doubt about that. I think some solutions that are offered to the market, put on the banner of AI and machine learning because it's trendy to do so, whereas they are really conventional, more static, rule-based type analytics rather than a true learning-based system. But our view is that in the midst of sort of busyness and a lot of hype, there will be successes and failures in terms of experimentations and proof of concepts to attempt to find innovations. And we actually recently had some stats. We analyzed this ourselves, and we show that staffing levels for data analysts and data scientists amongst the top 160 asset management firms, the largest globally, have grown fivefold from 2010 2016, and from 16 to 17, we're talking about growth of more than sort of 25 to 30%. So I think in terms of whether the reality is happening, it's definitely happening in terms of at least firms recruiting to start finding some sort of innovations or experimentation, and recruiting for data analysts and scientists to actually push some of these things through. The question is, for me, how fast this will come to fruition. When the internet phenomenon came in around the turn of the decade in 2000, a lot of it, there were a lot of hype and things like that, and out of that emerged different business models and challenges that that actually that has changed the industry as a whole. And I believe that some of the elements around AI and big data is going through the same thing. There's a lot of hype, but also amidst of that, there will be winners and losers, and something will come out of it, and things will change. So.
Great, thanks. So a question I think I have to do for yourself. Why do you think there is a need for increased sophistication analytics from buy-side firms?
Yeah, so I think there are a few factors at play here. As mentioned in the presentation earlier, firms are expanding their domain of investable asset classes for the various reasons and the drivers that I went through earlier. Some of these asset classes are fairly complex structures and need more sophisticated models and analysis. They're not bespoke asset classes. They're not plain securities that are marked with for which you have a market price. So there is more modeling involved for valuation and risk. Secondly, I think the skill and expertise level is higher in buy-side firms today. So after the credit crisis, banks were forced to opt out of businesses that attracted high capital charge, or were forced to outright spin off prop desks as independent funds. Okay, so this resulted in that talent and expertise which was used to bank level analysis and risk practices moving to the buy side institutions, where since they are used to that level of analysis and risk practices, they're demanding the same in their new roles. So there's a greater demand for higher level of sophistication that they were used to in their earlier roles. So software firms which are servicing both the sell side and buy side are uniquely positioned to address this demand. And lastly, technology. So I mean, there is just sheer amount of resources and compute power available right now is much more than it was, say, 5 years back, and it is available at a lower price point. So I believe these are some of the factors that are contributing to it.
Thanks, Abdu. Maybe you can provide a response to this question as well, which is why are more and more firms embracing cloud-based technologies?
Okay, so I think this is fairly, everybody is familiar with the standard list of what is the unique selling propositions for cloud, right? So firms don't have to maintain expensive infrastructure. They don't have a burden of an IT expertise and big IT teams. And there is faster SLAs, break and fix SLAs, seamless user experience, access from anywhere, faster time to market. So I mean, the list goes on and on. So these are some of the standard reasons. So all of this results in freeing up time for firms and can focus on core business. So this is the standard pitch. But I think the biggest factor by far is that firms, even traditional ones, are getting comfortable with putting their data on the cloud infrastructure. I mean, there was a resistance earlier, and a lot of firms were like in wait and watch mode. But I think we can comfortably say now that we are past that tipping point. And even like traditional firms, very conservative firms, are considering putting their systems on the cloud infrastructure.
Excellent, thank you very much. I'm afraid that's all we have time for today. And just to say that the recording of the webinar will be available in the coming days on our website. You can visit www.quantifysolutions.com. I would like to remind you to please complete the short survey once the session closes as well. Thank you to today's presenters, and thank you all for listening. I hope you enjoyed the webinar. Goodbye.
Thank you.
Thank you, everybody.